Hi there. Welcome to the Dynamic Positioning Indicator video, or the DPI. This is the main indicator that we use to decide whether or not we're going long or short. In this video, we're going to learn what the DPI is, take a look at it in context with long trades and short trades, the requirements of the DPI, and then we're going to take a look at the DPI in the different market phases, the trending phase, the unordered phase, and the emerging phase. So what is the DPI? DPI stands for Dynamic Positioning Indicator. This is an indicator that you've never seen before. It doesn't exist outside of the rapid results method. This is an indicator that the traders that do know about it have grown to really love. This thing is really accurate and it is an amazing indicator. It's a directional weight index kind of indicator. It weighs several pieces of information and evaluates the directional potential of the market. There are three elements to the DPI indicator. We've got the lead line, the follow line, and then we've got the histogram, and they consist of the yellow and red bars. The lead line, that's the blue line on the indicator. It weighs a slower combination of indicators, while the follow line is the red line, and it will weigh quicker changes in the market. It will assess a group of quicker moving indicators and evaluate from there. So we have the lead line, the blue line, and the follow line is the red line. The histogram is a series of yellow and red bars that fill a gap in between the lead and follow lines. The yellow bars mean that price is more than 50% bullish, that the weight of the different information that the indicator is comparing is more than 50% bullish, while the red bars mean that it's more than 50% bearish weight. The DPI histogram is the most important aspect of this indicator, the histogram, the bars. It'll be the first thing we look at in assessing a potential trade. If the histogram is yellow, we look for long trades. If the histogram is red, we look for short trades. If the histogram is yellow, we're looking for long trades. Then we look at the chart, and then we make the evaluation on the chart. Where is a long trade? What could we be looking at for a long trade? And again, if the histogram is red, then we look to the chart and see what we can find on the chart that agrees with a short trade. So we'll take a look at the DPI in action. At this point, we've got the DPIs underneath the market, and we have what looks like a really nice ribbon trade. We've got all the moving averages are in order, all of them. The 89, the 34, the 13, and the 5. And we have a short trade. The parabolic dots appear over top of the price. Price pulls up, hits the 13, closes down, the dots on the proper side. However, the DPI says no. We are looking at a bullish environment at this time. So the histogram bars are yellow. We do not take a short trade. At this point, we're only looking for long trades. Unfortunately, the market does not present us with any long trading opportunities, as we've got a technical short trend. So we don't look for, so we're on hold. But we do not take that short trade, and because the DPI filtered that out, we didn't take a loss on that trade. When the DPI histogram is yellow, we look for a long trade, or we look for a series of long trades. That's the direction we're looking for. Once the histogram is yellow, then that's our radar is going to be looking for the long trades. We're going to be looking for a reason to go long. We're going to be looking for ribbon trades or ghost trade, whatever the case may be. So we've got that white square on the chart, shows us at the close of that candle, that one little white candle where the arrow is pointing to, from that point on, we're looking for long trades. And see how the DPI picked out the change in trend direction. It told us that things were going to go long at the bottom of this downtrend. It told us that the weight now is becoming bullish. And from here on in, we're going to look for nothing but long trades, of course, until the DPI turns red. So while the histogram is yellow, we're looking for only long trades. When the DPI histogram is red, we're looking for nothing but short trades. Again, take a look at this image here, that gray candle where the arrow's pointing to, the boxes around the candle, and the histogram bar. That's the first candle to make the histogram bar turn red. And from here, we can see that there is a beautiful fall off. The market does go down. So even though the market is trending higher, it's a beautiful trend. We've got nice separation between all the moving averages, the 89s at the bottom, the 34s in the middle, the 13s over top of those, and then we've even got the 5 EMA over top of that. Like, the trend could not be nicer. But at this point, the DPI says, no, there's a bearish bias. So from this point on, all we're going to do is look for short trades because that is the bias in the market. We're only looking for short trades. And as you can see on the chart, the market fell off from almost the top. It's an incredible indicator. So the first thing I do is I look at the DPI. Instead of trying to figure out what trades are what on the chart itself, I'm going to look to the DPI, and then after I look at the DPI, then I'm going to try to find the trade. So once we get DPI turns red, then I'm looking for a bearish trade. I'm looking for a short trade, a reason to trade short. Once the DPI in the middle there turns yellow, then all I'm going to do is look for a long trade. I don't need to try to convince myself there's a short trade in here anywhere because the DPI is saying, no, we're looking for long trades. And then finally, again, the DPI turns red, turns bearish. So from there, all the weight is with the bears, and then the market plummets. So at that point, all we're doing is looking for the short trade. So it really does make your trading decision that much easier. It gets in on the change in trend direction very quickly and doesn't get too psyched out by the false moves that you see in the market. We can see in the, just off to the right side from the middle, there's some choppy action. The arrow goes right through it. Some choppy action, but the DPI stays bullish that whole time. It doesn't get phased or freaked out by that bigger gray candle. Market does pop right back, and it maintains the bullish trend just like the DPI was showing. So let's take a look at the DPI in the trending phase. If there's a nice strong trend, in the market, the price probably isn't going to move beyond the 13 EMA. And in this example, it's a beautiful example of a really strong trend. The price maintains within that ribbon, within that 5 and 13 ribbon, and the DPI is telling us that that's the way it's going. It stays bullish the whole time. No red histogram bars, so we can just take trade after trade after trade. As long as that DPI is yellow, we can look for long trades all day long until we get a reason to look for short trades, and that is when it turns red. So when the price moves to the 34 EMA, when there's a pullback in a trend and it is going to move to the 34 EMA, the DPI will often give us the heads up by turning bullish in a downtrend. Now, for the counter trend traders out there, the DPI generally gives us the heads up that we're going to make the move to the 34. Doesn't always work out this way, but it is a very strong indication that that is the direction we're headed. It doesn't mean the trend is going to change right away. What it means is there is going to be a fairly significant pullback, and that we should be aware of this. Once the pullback is finished with and we get the market going back in the regular trend direction, the DPI will change back to the trend color. Now, we have to be aware of this because trends can change. And you've seen a couple examples already where the DPI has pointed out that the trend is changing and it doesn't change back to the original trend color. So in this case, if the DPI never turned back red, it stayed yellow, we could really be looking for a change in the trend direction. But the DPI does turn red and the trend resumes. Now this is what happened a few candles later, is we had the DPI turn yellow. You can see the last bit of the DPI on the right-hand side. That's all yellow histogram bars. Price goes up, turns yellow, and we get that similar kind of 34, like the move to the 34 as we did before. Now we get a sell signal on the price, as per the moving averages. We've got the price hits the 34, closes down below the 13. That's a ghost trade. There's a short. The gray candle there had the parabolic dot move above it. However, the DPI stayed bullish. It stayed yellow. It said that the market is not finished with its upward move. And sure enough, if we had taken that trade, it would have been an instant loser. The DPI filtered out that trade. If we had relied only on the moving averages and only on the parabolic dots, which are very reliable, because that is the scenario, that is the environment. We're looking at this trade. It proves that it works. The DPI just took it that one step further and said, no, we're looking, we're in a bullish market right now. We are going to look for those long trades, and it saved us from taking a bad trade. Now, the trending phase, we're looking at the DPI in the trending phase. The emerging phase of the market will often act like the trending phase. Now, take a look at that image on the chart there. It's just a little narrow image. See that the emerging phase is when the 89 EMA gets in between the 13 and the 34. And during the emerging phase, that medium-term trend is what essentially is king. It's going to rule. So the medium-term trend is down. That emerging phase can be traded as a downtrend. Emerging phase is very short-lived, and so if the DPI is saying we're looking for short trades and you're in the emerging phase, then go to it. There's no reason not to trade, as the DPI suggests, during the emerging phase of the market. The DPI in the unordered phase. Now, the 13 EMA is between the 34 and the 89. The red EMA is in between the blue and the white. I do not recommend trying to trade this phase. There's times to trade and there are times not to trade. The unordered phase is chaos. It's chaotic. There looks like there's going to be moves, and often there are not. These moves will come back into the grouping of moving averages. Sometimes not trading is the best thing you can possibly do, and when the market is moving sideways, your account will thank you for not trading. The unordered phase presents challenges no trader ever wants to experience. It's the most dangerous time to trade. During the unordered phase, we are in a time of consolidation, or just there is no direction, no momentum in the market. Here we'll take a look at the unordered phase. We've got the bulls and the bears are content, which makes any trades questionable. If the bulls and the bears are not competing for a direction, you're going to find that during the unordered phase, you're going to have some content, which what we see in this chart, just nice, clean, kind of sideways. But you're also going to find some volatility where it moves up and down, very tight range, but it's very aggressive, and that is no good either. The DPI during the unordered phase is going to find some weight. It is going to try to determine where the market is biased, where it wants to go. Trading in the unordered phase is dangerous. I don't do it. I don't suggest you do it. Stay away from it. What we want are the trades with the absolute highest probabilities of success. And the trending phase and the emerging phase, those are the phases we want. And as you can see by the chart, that happens quite regularly. So we're not at any lack of trades. Just we have to know when to sit out. And during the unordered phase is the time to do it. Again, the DPI is going to find a direction. It's going to find some weight, some bias to it. But as soon as that weight is confirmed, often the market will change its mind and float back and forth. So trading during this phase is extremely dangerous. Now that I said all of that stuff, sometimes the unordered phase is simply the market passing through as it changes trend direction. So if it's going from a short trend to a long trend, of course, the market has to go through the unordered phase. The 13 has to pass through the 89 and the 34. And you can see in this example, even though this unordered phase is very small, price does pull back, it does retrace, and it's not as choppy as we've seen other unordered phases, but very difficult to trade. Once we get out of the unordered phase and into the emerging phase, everything really cleans up. The DPI is saying everything's good to go, and from there, we just trade with the trend. Again, this is the emerging phase. This is the phase when the 89 EMA is in between the 13 and the 34. The emerging phase always precedes the trending phase. And most of the time, the emerging phase will turn into the trending phase. So I like to trade the emerging phase as a trending phase. If there's a signal, I'll take it. DPI is very bullish. We've got the medium-term trend is up. The ribbon, the short-term trend also is up. That is a great setup for a trade. The DPI is telling us that during this emerging phase, the trend is up. All the moving averages say the trend is up. We'll go for it. All right, that's it for this video. Thanks for joining me, and I'll see you in the next one.